All right. Hi. All right, hopefully people will arrive for their sake. All right. Based on office hours yesterday, a lot of you are confused. So we'll try to clear it up. But just administrative matter, I'll make this announcement again, maybe at the end of class. I have an unexpected meeting today from 1:30 to 2:30, so I will do 12:45 to 1:30 for those who can come at 12:45, or 2:30 to 3:30 today. So I need to move the slots a little bit today. Most of you seem to want to come tomorrow. Tomorrow seems to be a very popular day. So tomorrow will be 1:30 to 4, as I said via email. Come one, come all. All right. What else? Okay. So in office hours yesterday, just should say that some were confused before. We're good. Thank you. Some were confused before office hours. Fewer were confused after office hours, so it's good to come. One question that came up that also seems to be in the emails. By the way, one last administrative comment. If you send me a question via email, I'm probably not going to answer. And it's not because I don't think it's a good question. I just don't have time to write detailed responses. I'll give you participation credit, especially for the nice little mini essays that some of you send, which is great. But if you have a substantive question, come talk to me about it at office hours. I don't know if you're really, really engaged in the class and you've shown, and a couple of you have gotten answers via email, but by and large, I just don't do that. It would take too much time. So come talk to me after class or at office hours. But one question that did come in via email and also showed up yesterday in office hours was the relationship between materiality and price impact for the 5th time, right? We've been sort of going around this so many times. But particularly the question arose how we can think about materiality in the hypothetical versus the actual sense. That Farrell and Roper kind of talk about this. And the way that you might, and I'm trying now to use a whiteboard since it's hopefully more intelligible. The way you might think about this is that imagine we're in this world of no price impact. I don't know if any of you over there can see this. Probably not. Yeah. All right. Now the whiteboard is a little problematic. All right. We're in a world where there's no price impact, and then there's an announcement or something. And the question is, if we observe the no price impact during a period of time, what can we say? How do we interpret that no price impact? And that really matters, right? Because we talked about these 3 different interpretations. One interpretation was that the information was not material. That is to say, it didn't alter the total mix of information available to the investor. And if the disclosure is not material, then that's great for the defendant, okay? But unfortunately, you can't conclude that the lack of price movement during the period of the misstatement, you can't conclude immateriality from the lack of price movement during the period of the misstatement because there could be other reasons, right? We talked about 2 of them. There could be countervailing news going the other direction, or it could be a confirmatory misstatement that sort of just reinforces what investors already think. And I want to bring out a point that came up in office hours, which is that there is an analytical distinction, okay, between materiality and price impact during that period of time. The analytical distinction is that during the period of time when the price doesn't move, okay, the materiality inquiry is focused on the hypothetical price movement. All right, does everyone see this? So the hypothetical price movement that is the subject of the materiality inquiry, which is not discussed at the class certification stage. We all know that, right, under Amgen. But hypothetically, what we're asking under materiality is if the information had been in fact revealed to investors, the truth had been revealed to investors, would the price have changed? So let me just say that again so this is clear. The materiality inquiry theoretically, okay, I'm not saying you can infer this from the data. I'm saying if you had perfect data, what you would want to try to do during this period where the price actually didn't move is you would want to try to tell a group of investors the truth and then see if the price would change. Okay, that's the materiality inquiry in essence. Did it alter the mix of information available to investors? And the way you would answer that is by thinking if they had been told. It's a hypothetical question. If they had been told the truth. Okay. Now, the point of this discussion is that the price impact test and the materiality inquiry actually diverged during this window, right? Because while in the hypothetical, if you were able to evaluate materiality, you would see a price change, actually you didn't see a price change during this window. So there's a divergence, okay, during the time when the price doesn't change. There could be a divergence, to make that point clear. If we're talking about countervailing news or confirmatory misrepresentation, then there is a divergence between the materiality test, the hypothetical price change, and the actual price change. Okay? So this is where Farrell and Roper are stepping in to point out that while theoretically there is a divergence in this hypothetical versus actual, we never observe the world in which the truth is revealed to investors during this window. Instead, we only observe a point in time when the truth is announced. And at that point, the two tests actually reunite and fuse back together again. Does everyone see that? Because while price impact during this period is not dispositive as to materiality, okay, that is, the lack of a price change does not unequivocally tell us that the information is immaterial, because it could be driven by countervailing news or just confirming expectations. When the price reacts in a confirmatory disclosure, then we can say certainly, all right, there is in fact both materiality and price impact. And hence the love for corrective disclosures. All right, we want corrective disclosures because they allow us to kind of put the two back together again. But as Farrell and Roper point out, this basically means that whenever we observe data, we never observe the materiality inquiry apart from the price impact inquiry. That the two are in the data always going together, even though there's a period during which hypothetically, theoretically, they should diverge. Right? Because the price impact test is concentrated on actual price changes to actually revealed information. The lack of price impact you could establish by showing that in the actual revelation of information, prices did not change. But that actual test actually diverges from the hypothetical test during this window because of the possibility of countervailing news or not meeting expectations. So it's during this window that we have a theoretical divergence, but in the data we can't tell. Hence why it's really great to have a moment of corrective disclosure, at which point, though, the two tests reunite, and it's very hard to separate them at that moment. All right. Yes, Magdalena. Yeah.
So based on what you said, my understanding now is that what courts do, and probably that's also in line with what Justice Ginsburg said in a concurrent opinion to Halliburton too,
Yes.
is that they really, in this early stage of class certification, they do not want to enter into more complex discovery of trying to figure out what was the price movement, but really sort out all the cases which are obviously not affecting the price, while bringing the cases more marginal or more complex to the trial, because
Right.
the certification, you don't really have all the apparatus to really deep dive and understand what was happening and what to do at that stage.
That's right. So Magdalena points out this is kind of what Farrell and Roper seem to think, and Jessica sent me a nice note about this right before class, which is that maybe we can think of the confusion between Amgen and Halliburton II, or what how Ginsburg's trying to reconcile this in Halliburton II, is to say, well, you know, we just want a sorting mechanism, kind of, right? We want to push, we don't want to spend time at the class certification stage figuring out questions of materiality which effectively rely on hypothetical inquiries. That is, if you're going to rebut the price impact, if you're going to show lack of price impact as a defendant, you will show it by showing that there was no moment in time when prices reacted to the information, like neither during the misstatement nor at the corrective disclosure. So you can think about it as like a pro-plaintiff view, right? The Amgen holding and the way that the court seems to be putting this together under Halliburton II is kind of like saying, yeah, those tricky questions of counterfactuals and hypotheticals and all this, we're not going to deal with at the class certification stage. We'll allow the case to proceed. The only way that defendants get to kick it out at the class certification stage to rebut the fraud on the market presumption is if they show no price impact. And I think Farrell and Roper point out that since Halliburton II, when they wrote their paper, which was, I guess, in 2016, the presumption had been rebutted like 7 times or fewer even, I think. Oh, well, 1 out of 7, right. 1 out of the 7 cases that they had, but then Grunfest at Stanford did a study before, and it was also exceedingly rare. So it's really quite rare to establish lack of price impact. I mean, prices are kind of always moving and updating. So yes. So one way to view this is we don't want to deal with these hypothetical constructs of what could have happened at the class certification stage. So that's possible. The other possibility is the court is just confused. And I think that's not unlikely to explain part of this, that the judges, you know, with the greatest of respect, have a particular view towards what did Roberts call social science gobbledygook. So there is a sense in which economic theory is not sort of highly valued. And you see what that does to the law. All right. So let's answer a couple more questions from office hours. Fraud on the market, insider trading. So this came up a couple times. Can fraud on the market help you out in an insider trading damages claim? I just want to reiterate, we maybe did not spend enough time on this in class, but the state of the law today is an insider trading damages action is governed by statute. Okay? So we discussed the evolution of the law and the challenges that judges had in figuring out, can you see this? Is this on? Yeah, okay. So, but if, you know, figuring out how we think about transaction causation in the case of an insider, because of the problem, as we discussed, that insider trading makes prices more accurate. And so we discussed how this is somewhat confusing to explain. But don't worry, because it turns out that my phone needs to be off. It turns out that Congress has solved the problem for us in that we have, what is it, 15 U.S.C. 78 T1, okay? And this statutory provision provides that any person who violates any provision of this chapter, whatever, by purchasing or selling a security while in possession of material non-public information, shall be liable in an action in any court of competent jurisdiction to any person who contemporaneously with the purchase or sale of securities that is the subject of such violation has purchased or sold securities of the same class. So this is a statutory causation, if you will, right? So no need to prove, because good luck trying to prove transaction causation in an insider trading case, right? It's very, very difficult. That was our conversation around the Friedrich case, around the one before it. I don't remember the name now. But we discussed the evolution of the law in this area, and we said, look, it's really hard to pin down what you would have done otherwise. Like, the insider isn't sitting across the table from you, lying to you and inducing you to buy securities on the basis of some, omission in a face-to-face transaction. That was kind of what happened in Affiliated OOT. But other than that, more or less in modern securities markets, that doesn't happen. So good luck trying to establish reliance. And fraud on the market isn't going to help you here, because I don't want to spend too much time on it, but just think about it, that fraud on the market is a presumption that you're relying on the integrity of the market price, and you would not have traded if the market price had been different. But remember that judges assume that insider trading does not move market prices. Okay? That the distinction between class actions in the eyes of the courts and insider trading cases is that class actions, or fraud by a company, is that these garden variety security fraud claims actually distort prices. The omission or misstatement of information distorts the price. But the way that courts think about the Martomas of the world is that the price actually is accurate. While Martoma is trading, he's just exploiting an informational advantage. We discussed economically how that doesn't make much sense, because Martoma is actually moving the price, but he's moving it more accurately, not less accurately. And in any event, we could think of a company like Elon as being mispriced during that window. But that's not how judges think about this. If this point isn't clear, come to office hours. Judges think about Elon as having been accurately priced during the time when Martoma was trading. Why? Because Elon didn't mislead the market as to its price. And because courts tend to view behavior as kind of driving prices. That's how they think. They think, who did something wrong? And we start there. It turns out that nobody did anything wrong in the case of Elon and Wyeth, except Martoma. And so we're not going to be able to say investors relied on an accurate market price that they would have not traded if the price had been different, because at the end of the day, the court doesn't think the price would have changed, okay, if Martoma's trading had been disclosed. But none of that really matters, right? None of that really matters, because you have statutory causation here, and or elimination of the causation requirement effectively. And on top of that, you have statutory, you have the disgorgement remedy codified, right? So the Elkind case was embraced by Congress, and now we have the total amount of damages shall not exceed the profit gained or loss avoided in the transaction or transactions that are the subject of the violation. Okay, so don't worry too much about this. It's not so common to bring insider trading cases, although you might see it on the exam, and you just need to know the stuff I said right now. Okay, it's not really something you should get too stuck on. Okay, another point that's made at the very end of Farrell and Roper is that we have Affiliated OOT, and I'm just going to read from page 17 of their paper. For omissions claims, plaintiffs seeking class certification may not need to rely on the basic presumption for class certifications, but rather may invoke the presumption. This is at the middle of page 17 of the article. They may invoke the presumption found in Affiliated OOT Citizens v. United States. What is that presumption? That presumption is a presumption of reliance in the case of a true omission. All right? So Affiliated OOT, among other things, stands for the proposition that if there's actually an omission, and be careful, most securities fraud claims are not omission claims. Okay? They are misstatements, by and large. But if, in fact, you could identify, why, let me just ask, why? Why is it, this is a test to see if you're sort of got the material in your head, why is it that most securities fraud claims are going to be misstatements rather than omissions? Yes? Bingo! Ready for the test. Good. Exactly. There's no general duty to disclose. All right? So, remember your name? Xander. Yeah, Xander. So Xander's ready. So Exactly. No general duty to disclose material information. Because of that, good luck trying to establish an emissions claim. Most of the time, the best you can do is to reach for some duty to correct or duty to update. We know that courts are going to construe that pretty narrowly, and that we're going to be looking for some kind of fundamental factual assumption that went into a projection. We're going to have the safe harbor. Remember, on the projection itself, we discussed that early in the term, and we're going to have Omnicare kind of sweeping in and protecting statements of opinion about the future, or about the present, that kind of have an implication for the future, like we believe our company is amazing. Turns out that that's going to get Omnicare protection. So you got to find some fact that underlied a projection that was actually factually wrong. That's going to be very hard and very rare, right? Remember the example of the ink being smudged on the fax. 10,000 gets replaced by 100,000. All right, those are the cases maybe where you'll get emissions liability. But by and large, you're not going to establish an emissions claim because there's no general duty to disclose material information. Therefore, the claim is going to almost always be a misstatement claim. But if in the event you're able to establish an emissions claim, fantastic. You do not need to show reliance. Okay, I am not going to spend too much more time on Scienter, but I'm happy to talk about that at office hours. Some of you had some questions, but in general, just remember, negligence is not going to be enough. Review the material in the casebook there. It's very rare for a securities fraud claim to fall on Scienter because these companies kind of know what they're doing, right? If a company says we have FDA approval for our drug, it's not a negligent statement, right? So it's not something you should mention, you should discuss it, but don't spend more than 30 seconds. All right. Let's remember now, Halliburton 1, we discussed very briefly, is an important case. It's in the casebook, and it stands for a simple proposition that loss causation has nothing to do with price impact. Okay, now, one sign that you're not ready for the exam is if you send me an email, like someone did yesterday, asking me about how you establish price impact for loss causation. All right, that is a sign you're not quite ready because price impact has nothing to do with loss causation. So if you say, the defendant can prove the absence of loss causation by showing there was no price impact, you do not understand the material. That is wrong, unequivocally wrong. Okay, so come to office hours if you do not understand the distinction between loss causation and price impact. But I'll just review it quickly. Loss causation is about the scope of damages, what kinds of future price changes, we talked about this yesterday with Dura, are going to give rise to damages. Price impact, okay, the lack of price impact is how you rebut fraud on the market, which speaks to transaction causation, not loss causation. So loss causation and price impact should not appear in the same sentence, okay? And in fact, there's an entire case, Halliburton 1, that's in your readings. For 2 weeks you've had it, that actually articulates this. Like it's the entire point of the opinion. And here it is. On page 1156, the Supreme Court, we do not accept Halliburton's wishful interpretation of the Court of Appeals opinion. As we have explained, loss causation is a familiar and distinct concept in securities law. It is not price impact. So don't take my word for it. It's right here. All right? So again, this is why I'm encouraging you to come to office hours. I think for some of you this is a little jumbled up. So let's try to make this clear. Loss causation is not a required element that need to be proven at the class certification stage. So neither materiality nor loss causation need to be established at the class certification stage. Neither materiality nor loss causation at the class certification stage. 1157 of your casebook, Court of Appeals erred by requiring EPJ Fund to prove loss causation at the certification stage. Okay. Why is that? Well, remember that at the class certification stage, we need to show, besides the 4 elements of Rule 23A, we need to show all of this is about commonality. And commonality, common questions, sort of trumping individual questions, this question of commonality to members of the class turns on whether they can establish class-wide reliance. That is the point of the fraud in the market presumption. The lack of price impact rebuts that issue, rebuts the presumption of class-wide reliance, whereas loss causation actually serves as a substantive constraint on restriction on liability. Okay? So these two need to be kept distinct. Also, Halliburton 1 tells us that loss causation need not be established at the class certification stage. I'm saying this all repeatedly so that it's really clear. All right? Okay. Questions on the material? Alistair?
Yeah, so is the actual doctrinal difference just that that for price impact it's proving that the corrective disclosures moved the price or the omission or material misstatement moved the price, and for loss causation it's that it moved the price and that movement resulted in the loss? Or is there a different doctrinal difference?
What is loss causation, right? Well, I told you yesterday, I gave you the statement from Dura that loss causation is some kind of proximate cause-like thing where we are going to try and make sure that securities fraud doesn't become effectively an insurance policy against all subsequent movements in prices following the misstatement. And we have a generic statement from the court that, the purpose of loss causation is to address the possibility that there could be all kinds of other things that actually caused the plaintiff's loss. But we haven't, Alistair, unpacked the sort of mechanics of how you would prove loss causation. And that's because to do that, we need to understand a little bit more about event studies, which is what we're going to do now. But I want to be clear, just at the doctrinal level, the distinction is that price impact, proving the lack of price impact, establishes that there was not we saw this with the fraud in the market presumption, either the market's not efficient or that the information is not material. Even though materiality can't be proved directly, we know that by showing the absence of price impact, effectively that rebuts the fraud on the market presumption. That is a presumption of transaction causation. That is to say, it is a presumption regarding how investors would have acted if they had been given the information, and the idea is that in fraud on the market, that if they had been given the information, the price would have changed and they would not have bought or sold. So price impact, okay, I know this is the 10th time for some of you, but just not all of you have it. So one more time. Price impact rebuts the fraud in the market presumption, which speaks to behavior. It speaks to trading behavior. It says if prices were in fact to have updated, we're assuming in the fraud in the market presumption that if the truth were disclosed, the price would have changed. The key idea is that the investor would have acted differently, because this is a presumption that satisfies transaction causation or cause and fact reliance, whatever you want to call it. Whereas loss causation is speaking to a different question. It is the plaintiff is coming and suing for damages of a certain number, $500 million, whatever that number is. And the question is, were those losses caused by the defendant's misstatement or omission? And that question has nothing to do with behavior. Even though in this confusing doctrinal mess, often price changes are being used to make inferences about behavior. We are now going to forget about all that when we discuss loss causation, and we're just going to think about losses, economic losses, assuming that we've satisfied the reliance element and we're now in the very final element of a 10b-5 claim. Okay? So you have to just separate the two. They're speaking to different fundamental elements of liability. All right. Any more questions before we dive into event studies? All right. So you should really read. I've come around to the view that this should have been mandatory reading. I realize I didn't give you a lot of time, so feel free to go back and read it and ask questions next week on Tuesday or Friday. Farrell and Saha, very, very good paper. Very clear. It was published in the Business Lawyer. So you cannot claim that it's excessively mathematical because lawyers actually published it and read it. But it turns out that there is a little math, which is probably scaring some of you, on page 166. So do not worry. We will dive into this. Let me see if I can get the picture up on the screen. Let's see if our CourseWorks is going to work, so we all can talk about the same stuff. Let's see. All right, here it is. All right, so, I think it would be better if we downloaded this, open this. No, that's not good. How do we open it in Reader? There we go. All right. I want to do it like this so that, okay. So now we can look together. So Farrell and Saha sort of unpack Dura. This was written in the wake of Dura. And we're going to use their discussion of this stuff first to understand the event study methodology, and then to see how it works for loss causation. But let's start with just understanding the event study methodology. So first of all, you have here in front of you Dura's share prices. So they announced the expectation of FDA approval for a new asthmatic spray device in April 1997. And there is eventually an increase, and the price kind of starts to go down. And then there is a lowering of the forecast, the earnings forecast, citing slow sales of their antibiotic product. That leads, or seems to be associated with, a massive decline, and on the order of 50% almost, from about almost $40 to a little over $20. That's in March 2nd, and then 1998. And then we have the price just hanging out for a while, and it starts to fall before the announcement of the FDA's denial of the asthmatic spray device, after which point the price barely moves. All right, you should be very familiar with looking at graphs like these and thinking about this. So the question is now, how do we understand, how do we analyze whether these price changes satisfy either the definition of materiality or price impact or loss causation? And the answer is we're going to use this event study methodology that I've alluded to now a few times. And in front of you is some letters. And don't worry, you don't need to know this for the exam. But I will try to explain the idea, and you do need to know that. So basically, the way that an event study works is we're going to try to figure out a relationship. A relationship is the relationship between the change in the price of a company's stock and other things that can explain the change in the price. And if you unpack this Greek here, what you see is basically that on the left side of the equal sign, well, there's two equal signs, right? So let's just focus on the equal sign, in between the two equal signs. All right, this ln pt over pt minus 1, that just basically is the logarithm of the ratio of the price on a particular day to the price the day before. Don't worry about that, what that means mathematically. It's basically just the percentage change, the logarithmic percentage change in the price of the company's stock from yesterday to today. So if the stock price was $10 yesterday and it's $11 today, it turns out that's going to be pretty close to 10%. Not exactly 10% because of the logarithm. They're using sort of like continuous compounding. It doesn't matter. If you've taken corporate finance, you'll know what this means. If you haven't, don't worry about it. But the point of this math is that basically we're going to say that the price change on any particular day can be explained by That's what the equal sign means. It can be explained by a bunch of things added together. All right? In other words, it can be explained by a bunch of different factors. One of those factors, don't worry about beta 0, but one of those factors is MT, where MT is the change, or not the change, the actual level of the, no, sorry, we're doing returns. The change in the price of the market, the return on a market index, the S&P 500 index or the Dow Jones index. So if the stock price went up by 10% that day, from $10 to $11, MT might, look like 5% or 9% or 7%. In other words, if you think that the stock price goes up when the market price goes up, what this little equation is saying is that you can think of the stock price as the market price plus something else. Okay? So if you think about this as being like the market in red here, and the stock price of the company, what it's kind of saying is just that when we observe the price at any particular point, we can say this value or this change is actually like this change plus something. And so effectively, the idea is that the stock price tracks the market price. And it does so according to the relationship that's given here. Meaning that as the market goes up by a certain amount, the stock price goes up by beta 1 times that amount. So let's work through a simple example. Take again this idea that the stock price went up from $10 to $11. So we'd have on the left side of the equals, we'd have here like 10%, let's just say. It's an increase of 10%. Suppose that the market, MT, went up by 5%. All right, I'll write this down so that you don't get lost. Let's just remember. Suppose that the stock price goes up by 10%. We're going to say that RT is 10%, or that's also ln PT plus 1 over PT. Okay, and MT is 5%. Pretend that nothing else is in this equation other than these 2, 1. So pretend that the equation looks like RT equals beta 1 times MT. Let's say that's it. That's all you have. Forget about the other stuff. Well, what this is kind of saying, just very simply, is that it must be the case that beta 1 is 2. Okay, the math is really simple here. If the stock price went up by 10% and the market went up by 5%, the only way that this works is if the beta 1 is 2. You can see this, just imagine, I say 10% equals beta 1 times 5%. You know that this has to be equal to 2. Has to be. Everyone see that? I mean, literally, it's just a relationship. But it turns out that this relationship is kind of like scaled, right? So if the market goes up by a certain amount, let's say 5%, and the stock price goes up by twice that amount, then we'd say that beta 1 here is like 2. So what this equation is saying is that what event studies are doing is effectively relating changes in the market as well as changes in an industry, which is this IT, relating them to changes in the stock price. And it's doing it by saying for every change in the stock price, you can imagine that there's like a multiplier, right? That multiplier is the multiplier that we apply to the market or to the industry, and that gets kind of added together to give us the change in the stock price. So imagine that we switched the numbers just to drive the point home, and we said that the stock price, the company stock price went up by 5%, okay, and the market went up by 5%. That would imply, what is beta 1 in that case? 1, exactly, right? Or imagine that the stock price went up by 2.5% when the market went up by 5%. Okay, what is beta 1? 0.5. You got it. All right, so the point is that the betas, for those who haven't taken corporate finance, is pretty easy. Just think about the betas as kind of how responsive the change in the stock price is to the change in something else. It can be really responsive, in which case it's going to have a large positive beta, and it can be not very responsive, in which case it have a small positive beta. What happens if the beta is negative? What happens if the beta is negative? Carly?
It moves in the opposite direction.
Bingo! Moves in the opposite direction. When the market goes up, the stock price goes down. All right. So are there questions on the basic, on the M, at least the first part here, of the beta 1 MT and the beta 2 IT? Davia?
So I have no background in
Yeah.
stuff, so
Not to worry.
I'm really lost right now. Can you please,
One more time?
yeah.
Yeah. So all we're doing here is just trying to figure out how the change in a stock price relates to the change in something else. Let's say the price of the stock market as a whole. So you hear people say, the stock market went up by 3% today. And you look at a particular company, and it went up by 3%. And you want to say, oh, that's interesting. Stock price went up by 3%, the market went up by 3%. What if that happens day after day after day? Well, you kind of might think that this stock tends to track the market pretty well. If the market went up by 3, the stock went up by 3. If the market went up by 5, the stock went up by 5. Say, well, that means I could write this relationship where I would put a 1 where that beta 1 is, and I just say, literally, the stock price is just 1 times the market. But what if, does that make sense? Yeah. So what if it's twice, what if it moves twice as fast? Imagine that the market goes up by 5%, but the company's stock goes up by 10%. And you say, well, the company's stock is just twice as, it's like twice, 2 times the market. So if the market goes up by 5 and the company goes up by 10, it's like doubling the market, all right? If the market goes down by 5 and the company goes down by 10, then it's just double down. Double up, double down. The beta 1 just measures the association between the change in the market and the change in the stock. Yes?
Going down at twice the rate, 0.5 or negative 1%? Negative.
Going down, if the market goes down and the company's stock goes down?
No, the market goes up.
Okay.
The price goes in the opposite direction.
Carly knows the answer to this. What happens if,
If it's a negative beta, then it has an opposite relation. Like
Right.
inverse relationship.
yeah,
But if the beta being 1 means that it's aligned with the market, what's the beta
of negative 1?
0.5?
Oh, it means,
That's fast, but going in the same direction.
exactly. So the market, this is this example which you can't see. The market goes up by 5, but the company goes up by 2.5. So it's still going with the market. It's just going half as strong. Right? Yes, sir.
So, excuse me, how often does like the stock price reflecting the market price, like that relationship, like how many times does it have to happen before we can actually assume that there is
Yeah.
some relationship?
Yeah, exactly. Reggie, right? Reggie asked a great question, which is like, how do we know? Like any single day, like the stock could go up at the same time the market goes up, but that could have happened by random chance. Like literally, just we picked a day when they happen to go the same direction. What if tomorrow they go the opposite direction? How many times do they need to go the same direction before we can say, oh, that beta is 1, or the beta is 2, or the beta is 3, or negative 1? So the answer is we need enough data. We need enough days. We need enough, if we're doing this on the daily level, we need enough observations, as we call them in statistics, before we can confidently conclude that the beta that we measure in the data is in fact not caused by random chance. So you can imagine you'd actually have, in actual data, you'd have a bunch of returns. I'm just going to think of this in terms of price changes, just percentage changes. And you'd have something like the return on the stock, which is this RT, and the MT here would be the change in the market. And you have like, what are we in April? So April 1st, I guess that was a Sunday, but whatever. April 2nd, April 3rd. You'd have a data set that looks like this. Okay, and imagine if your data looked just like, like we said, like the market goes up by 1, the company goes up by 2. The market goes down by 1, the company goes down by 2. The market goes up by 0.5, the company goes up by 1. All right, well, you would pretty quickly conclude that the beta must be, what's the beta? 2, right? Because the market goes up by 1, the company goes up by 2. The market goes down by 1, the company goes down by 2. The market goes up by 1/2, the company goes up by 1. Always just 2 times whatever happens to the market. Okay? So you need, Reggie, enough data to where you can conclude statistically that that relationship was not happening by random chance alone, by the fact that you just kind of pulled a few days out and happened to see something that you think is a pattern. All right, Davia.
How many times do you need to see that before?
How many times? Yeah.
Is there a number or
There are numbers, but it is a mathematical formula, right? And so if you take statistics, you learn that that you can actually figure that out. But I didn't put that as a prerequisite, and I don't want to scare you. All right, I'll give you the short answer. If you assume that the data here are normally distributed, which is the bell curve we're all familiar with, it turns out that we have what's called a T statistic, a T distribution. And that T distribution basically means that if the relationship between the beta and its standard error, all right, this is not on the exam. Do not hyperventilate. Do not freak out. But for those of you who just like to think about this stuff, it turns out that if the relationship between the estimate of the beta and its standard error are sufficiently large so that the standard error is actually sufficiently small, okay, you kind of need that estimate to be greater than something like 1.96. All right, so you kind of need the relationship between the beta that you estimate and the standard error, which is like the standard deviation if you've taken stats. You need that to be greater than 1.96. That's known as a T statistic. Okay, not on the test, but just so you understand, when they talk about T statistics and statistical significance, what they're saying is that you need some kind of confidence in the estimate that is greater than that number, all right? But that's statistics, okay? More questions? All right, now we talked, yes, Reggie?
Sorry, is there ever a situation in which the market can reflect, there's a relationship between the market and the stock price, but some event happens and kind of breaks this relationship?
Yeah, so Reggie asks a fantastic question, really good one, which is not explored by Farrell and Saha, which is, can betas actually change? And the answer is unequivocally yes. All right, so the research in finance has not caught up to the practice of securities law by and large. And it turns out that for about 15 years or more, there's been strong empirical evidence that betas move. They move over time. There are events that can change beta. And one big question in this area is, how does that affect the inferences we draw as to whether or not there was a misstatement or omission? So this actually does matter. One reason it matters, going back to Reggie's excellent point, is that if the beta itself can change over time, you often do not know whether what you observe in the data, and I'm going to say more about what I mean here, is driven by some kind of news that's unique to the firm, or in fact a changing relationship between the firm and the market. I don't expect this of you, but as you get into this, you'll start to develop an intuition that it cannot possibly be so easy as supposing that the beta is fixed, because the very same data that you're using to estimate this beta, okay, can actually give rise, like different samples of data can give rise to different betas. Okay, so because these can change with data, you should immediately have an intuition that there's some assumptions going into this. There's a little bit of alchemy here. We're kind of assuming a particular model, assuming that that model is fixed. So there are some tricks of the trade here that you should be skeptical of. But for now, I'm just trying to get the basics across, all right? To make sure we all understand the way it's practiced today, and then we can critique it all day long, all right? Now, what are the alphas here, all right? So this is where you really have to push through the fog of the last week of class and just eat the vegetables, okay? So the alphas are effectively estimates of the estimation error that's left over after you have, in fact, calculated a beta. So one way to think about this in this little example that I drew, you may or may not be able to see that this stock price seems to be tracking the market pretty well until about here. And one possibility is that whatever's happening here is because beta was changing, as Reggie pointed out. But let's just forget about that. Let's assume that beta never changes. What that means is that while you can clearly explain the stock price movement with the market up until a certain point, after a certain point you actually can't. And we think of that as a kind of error. We basically say, look, the model where the return is equal to the beta times the market, the model kind of breaks at a certain point. And the model breaking at a certain point often is caused by news, by idiosyncratic firm-specific events. And so what these alphas are basically averages of the error on each day of the period that we're interested in studying. So imagine that there's a disclosure right here. Okay, so we're going to call this D0. All right? And then this is D1. All right? So the idea is that at least when it comes to D1, there's a big difference between the expected change in the stock price and the actual change in the stock price. What do I mean by that? Well, we said that the beta times the market should give us a particular movement in the stock price that if, in fact, we were continuing the past, would look, something like this, right? You can kind of see how this would work if, in fact, the firm was just tracking, if the blue line were continuing to track the red line, then, in fact, what you'd have is kind of a leveling off of the firm stock price as it continued to track the market. And we're going to think of that green line, we're going to call that the expected return. Why are we going to call it the expected return? Because we're going to say this is actually what we would have expected if the firm were behaving according to the model, meaning if every change in the stock price was equal to some multiple of the market, then it should track the market at some level. Right? All right. But actually, it didn't track the market. We see that here. It turns out that there's a gap, fairly sizable gap, between the expected return and the actual return on this day, this D1 day, whatever we're going to call it. Now, this is supposed to be picked up by this alpha 1. All right? It's like a number. Suppose this is like 3%, and this here is like 4%. I don't know. Then alpha 1 looks like it's something like 1%. Means the stock price was 1% higher than what we expected it to be based on this model that links the change in the stock price to the change in the market or the change in industries or whatever. And this difference can't really be accounted for by the change in the market or any driver of a return that we would have expected would have driven the return. So that's why I said you can think of the alphas here as kind of the average error that occurred, error in the sense that the unexpected stock price change that occurred on that day. And so the test, why does any of this matter? Well, it turns out that the test for whether there was a material misstatement or whether there was price impact or whether there's loss causation to some extent, but particularly materiality and price impact, all turns on these alphas. That is how, in fact, econometricians prove that there was or was not materiality or price impact. The alphas are numbers that are estimated. They are effectively the difference between the expected return and the actual return. And like the betas, the alphas also have what are called t-statistics. The alphas also have uncertainty around them. And you don't need to worry about how we get that uncertainty, but basically, there's going to be a similar formula. This is definitely not something you need to know, the formulas, but you need to understand the idea. And we're going to say that that also has to be 1.96 or higher, whatever. The point is that the alphas are estimates of this error, this deviation from what we expect the stock price to be. And as Farrell and Saha explain in the article, which you will now read again, I'll just show you this. The estimated, remember, this was published in the Business Lawyer, so, don't kill me. Okay, the estimated coefficient of the ith day dummy is a measure of the market and industry adjusted return. In short, the abnormal return on the ith day. Think of like I as like number 1. Okay, so the estimated coefficient of the day 1 dummy, alpha I, dummy, don't worry about why we call it dummy, it has nothing to do with being smart, it's just the term that people use, is the measure of the market and industry adjusted return. In short, the abnormal return, the unexpected stock price change on day 1. The t-statistics for alpha I, which I just briefly mentioned, provide statistical evidence on whether the price move on the ith day, after controlling for, or adjusting for, market industry factors, is explained by random chance or by firm-specific news. A sufficiently large value of the t-statistics, generally greater than 1.96 for a 95% level of confidence, allows the investigator to conclude that the estimated abnormal return on the ith day cannot be explained by chance alone, and therefore is attributable to firm-specific news. This analytical framework has obvious implications for both loss causation and materiality. They're not, I don't know if they're obvious to you, but they were obvious to them. Okay. All right. Questions before we dive into the issues with this? Christian.
Just to make sure I've got it all clear, it's probably a really simple question, but when you're talking about price impact, you're looking for change apart from what you would expect to see in the stock price that day, right?
Change with...
whenever you're talking about price impact, you don't mean just the change that you would expect to see because of the beta, but sort of the alpha change.
It's the alpha.
Okay.
It's the change in excess of what you would have expected to see on that day. Notice why this is crucial. You cannot point to D0 here and say there was much of a price change in excess of what was expected. Okay, on D0, it just kind of continued to track the market. All right, so the alpha 0 here is probably like very small. So it's the alphas. Yes, the price changed on D0, but its change was totally explained by the link between the stock price and the market, and thus there was very little excess change. All right, I'm going to go as slow as needed on this to make sure everyone, I don't feel like it's fair to just give those who have an econ background a heads up. So, but you got to also ask. Okay, so tell me if you're stuck. Davia. Yeah. Yeah. The formula in the paper here, this one? Yeah. So this just basically says that on any given day, the price change that we see can be explained by a bunch of factors. One of them is the market change times the beta, or the sort of responsiveness of the stock to the market. plus some change in the industry that the firm is in, times some beta on that industry, some kind of responsiveness to that industry, plus everything else that cannot be explained. And for now, just think about it as, in fact, there is an alpha for each day, and that alpha for each day is the average excess return, meaning the stock price change beyond what we thought was going to happen based on the market and the industry, and the alpha for I for day I, meaning alpha 1 for day 1, alpha 2 for day 2, alpha of April 3rd for April 3rd, is just simply the difference between what we thought the stock price was going to do on that day based on the market, based on the industry, and what actually happened. Yes?
So this alpha, the idiosyncratic error, so to speak, is not broken down into individual disclosure or non-disclosure of information. It's mostly like a backward calculation of how different it was.
Yep.
In that case, can we use that as evidence for, say, when there is confounding information?
Yeah. So yeah, no. And so we're going to dive into that very briefly. But before we get into the 4 issues that Farrell and Saha, by the way, we're just doing Farrell and Saha for the next day, okay? Today and tomorrow, because this is enough. So we're going to go through it all, but I just want to make sure this is clear. Ben?
Wouldn't this react differently for, say, like a small firm or a large firm? So like a large firm, there's no material misstatement or omission. There's a real statement that some large firm makes that leads to a big change in the stock price of that firm, which probably has a stronger correlation with the market in that industry because they're such a large firm in the industry. But a smaller firm makes a similar type of representation, and their stock price changes a lot, but the market stays pretty similar because it's just a small player.
Nice. Now, Ben makes a very nuanced point, and a good one, which is that some firms, one of the dangers with putting industry in here as a predictor is that some firms actually are the industry. And so there's a certain cyclicality or circularity, but my friend, that is such an advanced point for the class. I don't want to, some of the people here don't even get this, but you're absolutely right that that's an issue. There are ways to address it, like don't put firms that sort of constitute an industry, don't use their industry, come up with, exclude that firm from the industry. Typically, easiest is just to exclude the large firm from the industry metric. But there are other ways. But yes, but I just want to make sure you guys understand this to start with. Okay, some of you do, some of you do not. Yeah, absolutely right, but let's not get too advanced yet. Okay, so what are the issues at the minimum that you all should know? Okay, let's start there. So proper choice of an industry index. So this is kind of like your point, Ben, which is that we got to figure out which firms are going to be used in the industry index. So even if we take the firm out, this is why it's not a perfect answer to Ben's point. You could take the firm out. But then, like, if something bad happens to Apple, then something good may be happening to Apple's competitors, and so it gets really thorny. But OK, we got to figure out the right industry index. Yeah. So we got to figure that out. We got to figure out the event window. So one of the problems, this is a very sort of central issue, is that whether or not there's actually an alpha can be really sensitive to which days we're talking about, right? All right, so imagine that we have, day 1 and day 2 here, and what's the alpha for day 2? It's probably like -1%. So it turns out that alpha 1 plus alpha 2 is, if alpha 1 is 1% and alpha 2 is -1%, what's the sum? 0. So it turns out that, like, in other words, if you just looked from, like, kind of like day 0 to day 2, maybe I didn't draw this very well. Okay. Turns out that if you look from day 0 to day 2, nothing happened. So maybe there was like an overreaction on day 1. Yeah, all right, so that's a problem. What I mean by overreaction, I mean that the stock price moved, but then it like reversed itself. And so if it reversed itself, what do? Do we say that there was price impact, or do we say that there wasn't price impact? Because the stock price reversed itself. I don't know. What do we say? Well, they explain it often makes sense to use multiple day dummy variables because of possible overreaction in the market to a corrective disclosure. All right? So there's a substantial finance literature documenting that in some circumstances there appears to be market overreaction to certain disclosures, and that it might take the market some time to digest fully and accurately the impact of a corrective disclosure. The market may correct for the overreaction over the course of several days, which would suggest the need to dummy out not only the day of the corrective disclosure, but 1 or 2 days post-corrective disclosure as well. Alternatively, there can be leakage of news about the disclosure before the actual official corrective disclosure, suggesting that in some cases we need to dummy the days or days prior. What do they mean by dummy? What they mean is that you can redefine the days over which you're taking an average. So suppose I were to just rewrite this. Yeah, I were to rewrite this as this is D1. That is the sum of the 2 days. Then clearly, in this case, we would now be redefining the alphas. We would be saying clearly alpha 1 is going to be 0 because we've redefined D1 as encompassing more than one day. All right? So you can actually redefine which days you're going to take averages over. And by redefining that, you can effectively change the conclusion. And they point out that you should do that, especially if you think there could be overreaction. And like you see here, if the price goes up and then it goes down, you probably want to include that entire period so that you can test if, in fact, whatever remains after the reversal is statistically significant. All right, is this clear? Okay. Trickle effects. Corrective disclosure can occur over a protracted period of time. The truth gradually trickles out into the market. As a result, while a single day's abnormal return may not be significant, the cumulative effect on the firm's stock over the entire corrective disclosure period may be. To examine such a hypothesis, one can test the significance of alpha 1 plus ... plus alpha m, assuming the disclosure period spans m days. In other words, if you think that on any particular day, the price change was not likely to have been, was likely to have been caused by random chance. So suppose you're looking at this window here, this period, and every day there's like a little bit of price movement. These are the days, you know, day 7, day 8, day 9. It turns out that whatever the difference here is, whatever the alphas are for these days, might not be statistically significant on a day-by-day basis. But if you add them all up together, the overall decline, in fact, is. You could accomplish the same thing by just redefining what a day is. Isabella?
Do you say that the extent to which you do this sort of correct for this trickle depends on the kind of news? Like, for example, if earnings is like really quick and easy to process.
Exactly.
You know, but if it's like the Alzheimer's case,
Yeah.
like it takes longer to really understand that.
Perfect. You got it. Exactly. That's the kind of thing you should be doing on an exam, right? So some of you are like, why does any of this matter? Well, you know, it matters because that is exactly the way you want to think. So suppose you have some evidence that the stock price moved in one direction or another, you know, you're going to make an argument as to the appropriate methodology for the appropriate window over which you should be estimating alphas, right, or testing for abnormal returns in English. And so you might say, as Isabella said, well, some kinds of information should be processed very quickly by the market, but other kinds may not be. And you might argue for the use of one methodology in a particular fact pattern over another. Brilliant. Brilliant. You see it? confounding events. On the corrective disclosure day, there may be a disclosure event as well as firm-specific news unrelated to the alleged fraud. In that case, the estimated abnormal return on that day measures the combined effect. Now we're back to the confounding question, right? Of the disclosure and the unrelated firm-specific news. This confounding effect problem is exacerbated when using multi-day event windows, as the longer the event window, the more likely it is that a confounding event occurred. So how do we deal with that? Well, we can delete the confounded days from the study, or we can use intraday data. If we delete the confounding days from the study, we might be removing potentially relevant information. They give this hypothetical you can study, but let's just look at the picture. Rotate clockwise. Here we go. So what they do is they talk about this company ABC at the intraday level. I mentioned this yesterday. One way to deal with a countervailing news or confounding event is to go to the intraday point. And here, what you see some supposed correction of fraud is ABC announcing lower than expected earnings or the analyst downgrades. The question is, which of these, suppose one of these is claimed to be the corrective disclosure. I don't remember which one they, the investment bank analysts artificially propped up the share prices by providing overly optimistic ratings. The share price, when the analyst downgrades his recommendation. Okay, so the downgrades here is the correction of the fraud, all right, in this story. So the point they're making is that if you look at the intraday level, when ABC at 10 a.m. announces lower than expected earnings, the price falls $5 from 25 to 20 by 10:30. And then it kind of recovers a little bit. But when we look at the analyst downgrading, which is the correction of the misstatement here, the stock price doesn't even move. Yet, it clearly fell. That day closing price 21.88 compared to its opening price, or the closing price of the day before. So if you looked at the daily frequency, you would conclude that there's an abnormal return, a negative abnormal return. At the intraday frequency, you can clearly separate the confounding event from the event at issue. And here you would conclude, quiz, was there price impact to the analyst downgrading or not? What would you conclude if this is the data? What would you conclude? No. Right, no, it didn't move. Okay. It didn't move, right? It just kind of stayed the same. And you can only make that point by looking at the intraday data, right? There was clearly price impact to the earnings announcement, but not to the analyst downgrade. Okay, so their point is that when you have confounding events, you can actually go to the intraday level. And that's a great way to address this problem. All right, we've got a few more minutes left. Let's see what else they say.
Professor Nitz?
Yeah.
At the intraday level, is the test meaningful at all? Like if you're comparing it to the market movement in the last 2 hours, whatever, or is there just enough noise that a 2-hour window might not be?
Great. So Martin, not Felix, right? Martin says that maybe some of these stocks don't respond fast enough to the market, and you're really in trouble on the intraday level. And that's exactly right. So intraday data is wonderful because it's very precise. The problem is a lot of companies aren't traded that heavily, arbitraged at the intraday level. And these sort of, we kind of glossed over why it is that a stock price should be a multiple of like the market, like 2 times the market, or 1 times the market, or 0.5 times the market. And the answer is kind of theoretical, but at the end of the day, someone has to like bid the price at that point. So this is actually, Ben, this is a really important part of his question that you should pay attention to, which is that a large company, you might say, automatically could move the market. And that's Ben's point, and that's right. A small company doesn't automatically move the market, right? Now, really, no large company is that big that it moves the whole stock market. But there is a sense that maybe when news is really bad, like you'll read in the Wall Street Journal, you know, Goldman Sachs leads stocks on a rally, And there's a sense that maybe Goldman is kind of dragging the entire market with it, that investors are making decisions as to buy like market indices on the basis of what happened to Goldman. It turns out that a similar process can sometimes work for these smaller companies, but doesn't always work. So there's like a really interesting area of research around, who it is that is actually arbitraging, so to speak, the change in price for smaller companies. There's a little bit different gloss on your point, right? Which is that like maybe smaller companies need someone to bid the price up or down based on the market change. And why is it? What is the mechanics behind this beta? How does that actually happen? That the price of a small company moves in a particular direction with the market. Some of it can be explained by kind of index investment funds, but it's actually a pretty complicated question. What's going to happen, though, as a result, if you don't have that sort of arbitrage, is that at the intraday level, it may very well be that the price of a small company diverges from that of the market for a long period of time in intraday terms, like for 5 hours. And so then you're going to be out of luck with this intraday event study because you're not going to have enough of a precision in your beta to say that the alpha, right, the excess return at 10 a.m. was actually alpha, right? Because you're just not going to be able to say with enough precision, going back to Reggie's question, how much data do you need? Well, the problem isn't just how many data points. The problem is if you can't with certainty establish a beta, because at the intraday level, the stock and the market are kind of gyrating too much against each other, there's no clear relationship, then you're really going to have a hard time establishing alpha, right, which is that there is some excess return. All right? Magdalena.
But this alpha factor in that situation could be still measured through like we look at on the longer period, and
yeah.
we realize that the small firm is kind of doing this all the time, so it averages out.
Oh yeah, but then you will have the problem of the confounding.
There's nothing then we can establish that there's nothing unusual in the stock movement.
Oh, absolutely. But on this day, we had 2 negative events, right? So 2 negative events, both of which move the price down on that day. You're going to have a really good time as a defense lawyer proving no price impact, right? Because you're going to be able to say, Martin's story, there's no intraday, there's not enough intraday price movement to pin down a beta at the intraday level. And at the daily level, there's a confounding event that released truth to the market. No class certification. No class certification, right? Yes, sir.
Can we make an argument that the market rating views were expected or factored in the downgrading the analyst rating when the first factor happened? So even if you break down the intraday level, you can't really actually one price.
Yeah.
One event.
Yeah, so some of you are really into these advanced questions. That's a good one. We're going to come back to this tomorrow because it's going to kind of relate to loss causation. Okay, so now as much as I've tried to keep these ideas separate, the idea that there could be like something else that caused your loss, turns out you're going to use the exact same methodology to establish that. The something else that caused your loss could be the other news, or the story could be, the other news actually was predictive of the fraud, which is what you're saying. So yeah, so they're going to talk about a few examples of that in the paper. But just remember that if you can show no price impact, you kick the case out at the class certification stage. All right? Now, the distinction between that and loss causation is, your question is actually a good example. Because often what will happen is it's not that you'll succeed in disproving price impact, because there'll be some market reaction. This is an unusual case, right? There'll be some market reaction usually to the second announcement. So you won't succeed in kicking the case out for no price impact. But when we get to loss causation, there's going to be a problem with damage measurement, because we're going to have to separate your point. You could imagine a slightly modified version of the question, or the hypo, where the analyst downgrade does lead to a decline. But then the question is, how much of the loss is attributable to the earnings versus the analyst downgrading? And most of the debate is going to be there, because there often is a price impact. It's often easy to establish. are difficult to rebut. But at the end of the day, there's a lot of stuff happening. And trying to separate what caused your loss is going to be the mission of applying Dura. So the reason why you need to understand event studies is because these are the tools you're going to use to figure out not only whether there was materiality or price impact, that's going to be the easier burden to satisfy, but whether in fact we can identify the losses that were caused by the misstatement. We're out of time. 12:45 today to 1:30. For those who didn't hear, modifying office hours today, 12:45 to 1:30, and something like 2:30 to 3:30 in my office. Otherwise, tomorrow is as is. See you then. Yes, last day. Don't worry. No more math. Well, I don't know. We're going to finish their article tomorrow. There's a little bit more math. Not a lot. No more Greek. No more alphas and betas. Hey, Dick. I've got to run. I've got 3 minutes. What's up? Don't worry.
It's like you and my attack professor are on a mission to confuse me.
No, you are going to kill it.
No.
Watch my prediction that you will kill it on the exam. I have a feeling.
Far from it.
You will.
So, in the context of the exam, am I going to be trying to apply this?
No. This is not going to be on the exam. The math, the Greek, but the idea, right? That there's some expected change in the price, and then some deviation from that. And we've got to be able to separate those. That's what I want you to understand, right? Yeah, the corporate finance is supposed to cover some of this. It depends on who you take it with, but Tally does a great job on this.
Okay, from like bare bones basic. I'm like a history major. I know nothing.
Take one of Eric's classes. He's fantastic. He's the best at this stuff. Merritt is great too. Merritt's teaching it this term, but Eric is I would send you to Eric is a J-term class. He's teaching next year. Or maybe it's a legal methods too. But anyway, it may or may not be open to upper years. I can't remember if he did it for 1 hour. Anyway, but talk to him. He's the best.
Okay, thank you.
No problem. Hey, Chris, what's up?
I had a quick question about what we're talking about. I don't know if we got there yet, but with price impact, do you just look to show a statistically significant alpha? And then for loss causation, we look into the alpha itself and see what is caused by the actual corrective disclosure?
So right, that's right, exactly. So loss causation is going to turn on the story you can tell around what drove the alpha.
Okay.
Right? Exactly.
Okay, so price impact is antecedent to the loss causation, but otherwise, okay, great, that makes sense. Thank you.
Yes. Yes.
Hi, how are you?
Oh no, but then